Charlotte McLeod with the Investing News Network, and here today with me is Tavi Costa, partner and portfolio manager at Crescat Capital. Thank you so much for being here. Nice to see you.
Thanks for having me. Yeah.
Nice to see you. So we're here at PDAC. We've made it to day 3, and I just want to check in with you to start off on the sentiment of the show, themes that you've been seeing here.
Well, there's a lot going on. I think there's certainly one of the themes has been battery metals. I think a lot of people have been focusing on that. Not a lot of focus on precious metals, which to me continues to be attractive as a place where the lack of attention tends to create a lot of inefficiencies, which usually creates opportunities. So I think that has been one of the things that continues to show. Most of the majors continue to be extremely disciplinary. In other words, I don't think we've ever seen a time when there's so many cheap projects and cheap companies out there, but they're starting to engage with some of our top companies, I would say, which is a new theme, I guess, for the high quality assets. But I've never seen a time when they're paying this much dividends and doing buybacks as much as they are, relative to what they've been doing in terms of investing in their own businesses. And outside of the sentiment itself, I think there's another interesting thing is that markets are starting to reward companies for being aggressive and not for just returning capital to shareholders instead. And this is happening not just with metals and mining, but also with energy companies and so forth. So that's my 2 cents on this conference and overall sentiment.
Interesting to hear. And I wonder, can you explain what you mean by rewarding companies that are aggressive? What does that look like?
Yeah, well, look, I think if you break down the commodity space into parts, and the energy space has been in sort of a bull market since the sector became uninvestable. So majority of the institutional allocators, because of ESG mandates, have not been able to allocate into that space. But because of that, and I guess the perfect timing for one of the best bull markets for energy that we've seen in the last 2 years. Now, if you break down and you backtest the best factors that have been contributing to performance within the sector, is not the companies that are paying high dividends, not the companies that are doing high buybacks. In fact, is the ones that are doing acceleration in CapEx, but also the ones that have been increasing production. So companies that are being aggressive in terms of exposing themselves even further to the commodity they're working with is something we're seeing very clear in the data, that the performance is 40 to 50% higher for most of those businesses. And that's just has nothing to do with the market cap issue. It's just really on the back of just how larger companies are choosing to allocate their capital. Now, in the metals and mining space, which we haven't been in a bull market like we've seen in the energy space, now you're starting to see that the underperformance of the overall industry is, if you separate it, just looking at the top 50 companies, and you look at the top 10 and the bottom 40. And I'm saying the top 10 largest companies versus the bottom 40 smaller businesses. You see a drastic difference between the two. One of them, the bottom 40, CapEx is back to 2011 levels, which is something no one is talking about. In other words, companies are spending capital again. And you can see that the free cash flow is actually one of the worst levels we've seen in over a decade. But it's not because they're not making money, it's just because they're spending more money than what they make. They actually have more cash than the other companies because they've been accessing the market through equity issuances more than the top 10 miners. And so you got an investing mode side versus a disciplinary side. And then you look at the performance difference between the two. On a median basis, it's actually quite similar. So they're not getting penalized. That's the big point. They're not getting penalized for being aggressive. To me, this is a very interesting takeaway. And I think I want my companies to be very aggressive in exploration and development and producing assets as well.
Right, and speaking about your companies, so we spoke last time back in October about Crescat Capital's strategy, which, if I'm understanding correctly, at a basic level, it's long commodities and Brazil and short equities over the next decade.
Yeah.
So I wondered if you could talk a little bit more about the commodity breakdown within the portfolio.
Metals and mining has been one of the largest focuses. I think there's a lot of ways to skin the cat here, but there are going to be some folks that like to invest in the producing side and some other folks that have a better niche in the energy side. I would say Crescat has definitely a niche in more exploration. That's just because of our views about the industry, the need for most of the major companies to replenish their reserves. And I know this is a topic that's been in the case for a while, but in our opinion, the probability of some of the companies that we have of finding major discoveries that are scalable and economic are still not reflected in the prices. And so to us, if you take a hybrid venture capital approach of investing in a very diversified way of a lot of businesses and taking a large stake on them, if one of them pays off, which in our view the odds are much larger than one, you can pay off your whole strategy. So we've been focused on that section, but we recently hired a geologist as well to work with us in the energy space too. We've been investing mostly in mid-cap and larger names, I would say, in the energy space, trying to focus on companies that are being aggressive, not the ones that are doing a lot of buybacks and dividends. But that's just our opinion. And then the Brazilian side of it is certainly involved with the commodities. It's a very large economy that is extremely exposed to commodities. If you'll see the correlation between commodity producers globally and energy and Brazilian equities, it is very tight. And so we think that there's good reasons for why you should be deploying capital into that camp as well. So it's sort of a basket. So metals and mining are probably about 50% today, and then 20+% in energy, and then the rest of it is either agricultural commodities, uranium, and some other things like Brazilian assets as well.
Right, so let's talk about some of those commodities then that are represented in the portfolio. So for gold, one of the themes right now is that we're seeing all this M&A activity, or at least a little bit to start off 2023. I wanted to get your take on that and ask if these are deals that are making sense to you. Is this a trend that's going to continue into the year?
Well, I think the majority of the gold deals are still extremely cheap. I was just talking to a company right now with significant number of resources. We're not even an investor, trading a sub, $40 million market cap, which is something unheard of given the level of and quality of the resources that they have. And so it is fascinating what's going on. Yes, the lithium space is kind of lighting up some of the, I would say, activity in this mining space, but if we get just 1/10 of the valuations we're getting in lithium into the precious metal space, it would already be a very, very good market. And obviously I'm joking, but I do think that there's, it's a good market for someone that is looking to be creative. And the problem in this industry right now, there's obviously a lot of problems. It's a reason why a lot of things are very cheap. But one of them is the fact that unfortunately, majority of the CEOs of the companies, that even the companies we invest, are not really looking to build things. They're just sellers. They just want to build something and run up this speculative side of the Lassonde curve by defining a resource, but not really building a new mine. And we really need this. We really need to see new projects coming online. We might need to see a new major company being created. I think it's creating as well a very good, a lot of room for someone to be very creative. We're trying to be that creative party and maybe figure out a way to take advantage of some of the companies that no one really wants to take over or build a mine and actually do something profitable. And so I think there's a lot of room for folks to be creative, and obviously a lot of opportunities in that camp as well.
So for you, when it comes to gold, precious metals, you would rather see a company that's going to take their asset through to production instead of one that will be selling it off?
Well, it doesn't necessarily need to be the case. I guess my point is, it's very telling when you have an industry that has been through what we've been through in the last 15 years. I think it's somewhat normal for someone to be willing to sell their company, their baby, for 3 times what they pay for, rather than 20, 30 times. And this mentality, I think, is justified by the pessimism in this industry. But do I think that that's the best strategy? No, I mean, I don't think that that's the best strategy. And I think the fact that we have a very minority of folks willing to put the time and effort into building something is also very telling about the supply constraints that we may continue to have in the space as well. And while we may have a lot of reasons for why we like gold and silver and even other metals, one of the things that really created the two major bull markets we've seen in the last 50 years, and not a lot of people talk about this, but is really global production of gold declining for a secular period. And that happened in the 70s, was an 18% decline in global production of gold. And in the early 2000s, we saw that as well, about 11% decline for a long-term period. And so there's a lot of reasons for that today. I mean, the Green Revolution, this changing focus away from precious metals into battery metals, institutional capital forcing those companies to do that, companies not spending capital and giving capital back to shareholders through dividends and buybacks, so people not being builders but yet sellers. And so I think this is all kind of connected to the sentiment and the issue, but again, I don't think this is the end of the world. I think this is a very good opportunity for whoever wants to be creative and create something new and exciting.
Okay, I think that gives us some idea of what's going on in the precious metals market. I do want to check in with you as well on uranium. And to start off, I'm wondering if you can talk about where you think we're at in that cycle.
Well, we like uranium. I don't think we're an expert allocator in the space, but if I would offer my views on it, it would be that I like metals, the precious metals, a little better as far as a lot better in terms of the case for it, just because the supply case is more compelling, and the supply case for uranium is not as compelling. Now, I think it's a political case that is very strong in terms of this move towards a greener world, and I think uranium is probably going to be part of this. And so, do we have investments in the space? Yes, I think a lot of things are really cheap there as well, but I do think that there's two things that really haven't happened yet in this market. I mean, everything, part of my presentation here was to explain this sort of macro domino effect that we tend to see. Everything in the macro world tends to happen with the domino effect. One thing impacts the other, that then impacts the other, and you see unintended consequences sort of unfolding. And I would say that what's happening today here in the market, we haven't seen yet two dominoes falling. And I don't mean falling in a bad way, I just mean we haven't seen those things really unfold. Those two are, one of them is the equity markets, overall equity markets. I think the way we approach that are still, investors are conditioned to think that we are basically entering another period of high growth and low cost of capital. I think that's going to be a shift. And the second one is kind of this reemergence of gold as a central bank asset and inflationary asset as well. And I know a lot of people disagree with this, but I think this is a slow movement that we are still to see outside of the 60-40s portfolios, the growth to value transition that we've seen recently, and other issues that I think are all happening at the same time. So.
All right, and one thing I've heard you say before is that we're entering an age of exploration, which sounds really good for all these companies here down on the show floor at PDAC.
Yeah.
I do wonder, where is the money that they need to conduct that exploration going to come from? Because that seems to be a concern for people at the show.
It's a very good question. You go back to the 90s before in the tech bust, or really the tech bubble, what inflated that whole sector at that time was really private equity and venture capital. Access of capital was really entering that space and helped to inflate those assets over time. I think that the green energy side is maybe a lot of, believe it or not, a lot of energy companies are actually printing money today, right? So they are getting access for capital to make some shifts in their own businesses. I think part of what we're going to see is slightly from the 60-40 idea, I should say, the growth to value transition, where companies that are profitable, the same way energy businesses became so profitable like they are currently, I would say that especially the major companies that have consistent free cash flow will continue to be very profitable. And the profitability will start to really attract more and more, I guess, large pools of capital as well. And that is really on the back of when you have higher costs of capital, certainly constrains a lot of opportunities in markets in general and forces you to really focus on the bottom line growth rather than top line growth. And that ultimately has to have an impact on, an influx of capital into mining. And so this has been my thesis for a while. And I think the other thing that could happen that could be huge is, if you think back in the 70s, the central banks that had most credibility with their foreign currencies, they used to have a very large percentage of gold relative to their international reserves. So any currency today, in order to be credible, needs to have a high quality international reserves. In the 70s, that used to be 70% was gold. Today is less than 20%. And so we're starting to see that beginning to increase. If we go back to, let's say, 40, 50% of gold relative to international reserves, I think we can see an influx of capital of close to $4 to $5 trillion just from that into the gold space, not even silver. And so what would that do to the overall market today? I mean, probably very positive, my 2 cents, yeah.
Probably very positive for sure. So as we're finishing up, are there any final thoughts that you would leave investors with during this environment we're in?
I think my final thoughts is that, we did some research on what's going on with equity markets in general, and we really had 5 decades of negative performance throughout history. And I'm referring to the overall stock market. And you can break them down into 2 categories. One of them is the inflationary periods, and the second one, it happened during times when you had very frothy valuations. But as I said, there are 2 categories that are separate. Today we have both together. We have the high cost of capital, and at the same time we're starting this decade with the valuations, even compared to times when you saw inflation, where we're not at high teens, we're high 20s. Like CAPE ratio today is at 29 times. And so I think there's going to be a lot of readjustment of prices relative to fundamentals, and I think there's going to be a lot of readjustments in terms of risk that is not being perceived as risk, and high duration assets. The assets really need to be repriced a lot lower. I think mega caps are a big risk right now. That's my opinion.
Okay, well, thank you so much for coming by to share your thoughts on all these topics. I think you left investors with a lot to think about.
Thanks for having me.
And once again, I'm Charlotte McLeod with the Investing Network, and this is Tavi Costa with Crescat Capital.